The content discussed on this podcast is for informational and educational purposes only and should not be construed as financial or mortgage advice. Always consult with a licensed professional before making any decisions regarding mortgages or financial matters.
Welcome to the Canadian Mortgage Show. Here are mortgage professionals Alex Pang and Alex Shanks to cut through the BS and educate Canadians on all things mortgages and real estate.
Welcome to another episode of the Canadian Mortgage Show. I'm your host, Alex Pang, along with my co-host, Alex Shanks. How are you doing, buddy?
Not too bad. This is a bit of an emergency podcast here. The news, oh my goodness.
Yeah, we're not going to talk about our lives, so let's just get right into it. Alex, what do you got?
So, I'm going to talk about some other stuff, but we got so much news here today. We got the government's changing how mortgages are going to come out for first-time home buyers. We got inflation in Canada. We got the US dropping interest rates. So let's just go one by one here and dive right into it, Alex.
First off, it's rolled out that insured mortgages, 30 years, have been expanded to all first-time buyers. Now, previously, that news was, I believe, early this year, like April or June-ish, where they allowed 30 years for insured mortgages on new builds only. And we knew at the time.
Let me tell you this, Alex. Did you get a single person that did it?
No. I mean, that's such a small segment of the population that no one has done it so far in my business. And neither is yours, right?
This makes what they've done. Yeah, what they've done now makes complete sense to me. They should have rolled that out right away.
Yeah,
that's just the way it should have came out.
But here's a bigger one. What's that bigger one that the government mentioned?
To rack up a bunch more debt, you get to increase an insured mortgage up to $1.5 million. Previously, we were capped at $1 million, and for people to know, it's 9,999 is what it used to be. And we know that home prices have increased. I think it should have happened earlier. This was set in 2012. But do we need to go to $1.5 million? I'm excited for us to crunch down the numbers here, Alex, to show people how much this is.
There was enough chatter in the marketplace that builders, homeowners wanting to increase it to 1.25 million. Now, this is a huge jump. It's a 50% increase, essentially. Now the details are still it still needs to be released. So we're just basing this on current information that we have. For a 1.5 million home, based on what the current rules are, you would need $125,000 as a down payment. Now, the insurance premium currently at 4% on the highest loan to value tier would be about $55,000. It'll probably be a little bit more once everything is released. So you're taking on a $1.43 million mortgage. Now, Alex, what kind of income do you need to qualify for that?
Well, I will say the one shiny thing here is the down payment drops $175,000. If you were to try and buy a $1.5 million home before, at 20%, you needed a $300,000 down payment.
Mm-hmm.
Which, unless you won the lottery, had an insanely good income, which we'll talk about in a second, or you were getting a gift from family, that was quite hard.
Mm-hmm.
It's nice to see that the down payment's gone down, but that debt of a 1.43 million mortgage on one property, that blows my mind a bit.
Yeah.
Now, to be able to qualify for something like this, you would need to have a $305,000 combined income. So either you could have that yourself, you could have it from partners. Now, we see incomes all the time, and the people that have good incomes are software developers or people that work in the oil industry.
Mm-hmm. Mm-hmm.
There's not a crazy amount of people out there that are rolling around with 300K incomes.
Exactly. And typically, if you're looking at business owners or CEOs, they don't get paid T4. They get paid dividends, or they have shares in the company. So they're essentially self-employed, and they write down their income. So their income on paper is not 300,000, even though they may be making that. So we're talking
those
about
people
actually
already
employees.
Have the 20%.
Exactly.
Yeah, those people have 20% down payment, so it doesn't even matter to them. They qualify so easy with their companies. This is just like a T4 employee.
Exactly. So unless you're in the high income earner category, in order to have a $300,000 income, you're going to need mom and dad to co-sign for you.
Yeah. And the monthly cost on this mortgage, I mean, hey, it's great to say, hey, mom and dad, you can co-sign for me. I have a $1.5 million home now. Your monthly cost is $7,300, just mortgage.
Wow.
That's nothing else.
Geez. Like I can see ratios for you viewers. We have to follow these numbers called debt ratios. Basically, it's the debt you're able to handle relative to the income that you're making. Man, this is the number that we have to follow is 44%. Is far exceeds, and we know when mom and dad are co-signing, they're likely not going to be paying the mortgage. They're there just to help you qualify for the mortgage.
Exactly.
So the
Yeah,
real
that's
number
you
is
really got to
probably more
sit
like
with people.
60-70% in your life. So yeah, you can qualify for that home, but you're going to be eating instant noodles and scrimping and you're going to be house poor.
To me, it's crazy, but I mean, I think it's nice to know that for one, it was always like being stuck right at that $1 million mark of like someone was buying a new build at 950. You add GST, and it's like, well, crap, they now can't go and get that place.
Mm-hmm.
So I think there's like it is nice to see for some senses. I think a very limited of people are going to be going up to 1.5 million with less than a 20% down payment.
And
Unless you're buying, the crazy thing is you can buy apartment buildings in Alberta still for like 1.2, 1.3, and you get all those rental income. Like that's where people maybe get creative here and buy like duplexes, like bigger houses to reduce their costs. Cause like you can't be paying $7,300 out of pocket.
exactly. Now 1.5 doesn't get you anything special in the lower mainland or the GTA. In some
Yeah.
parts of the Fraser Valley, 1.5 can get you a home with a basement suite, and you might get a 1 or 2 bedroom basement rental for anywhere from 1,500 to 2,000. So your net monthly cost could be as low as 5,300, but that's still $5,300. That's nothing.
Yeah.
And we know mom and dad are co-signing, but they're not going to contribute to the mortgage. So really, let's say a couple is making maybe 150 to 200. So you're paying 5,300 on, in reality, a couple making 150 to 200, something like that.
Yeah.
Right. So
That's just too much of you're just becoming houseborn. I personally when I show people how to co-sign, it's for a reason of like, hey, right now because maybe we were trying to use a 2-year average, but we can't use that income right now. It's not to say, hey, go buy that $1 million home. I only bring in a co-signer if it's because we can't qualify for a specific reason.
yeah, this, even though you can qualify for it, doesn't mean you should. So,
Yeah.
and another thing that just it has my mind blown is what first time buyer is going to go to 1.5 million on their first purchase. I know when we first bought our place, we just wanted to get into a 1 or 2 bedroom condo. And in our part of the world, a 1 or 2 bed could be anywhere from 5 to 700,000, depending on where you want to live
Yeah.
and the location and stuff.
This is an interesting question, actually, Alex. Not what was the price of your first home that you ever bought? Like what was that price?
We bought in 2005 our first condo in Burnaby. It was 800 square feet. It was 250. When we bought it,
Yeah.
we thought it was expensive because
Yeah.
our friends bought theirs for 180. They thought it was expensive
Yeah.
because their friends bought for 150, 120. So it's always expensive. Uh, if you look
When
back,
you're
it's
buying.
relative. But we know
Yeah.
for sure,
Yeah.
like it's a pretty good certainty that long term it will go up in value. Now, in between those years, it could be flat. It could have dropped the last couple of years, but long term, if you're looking at that kind of trajectory, it will increase. Now, that same,
Especially
yeah,
especially with what they've done here today because of these changes,
exactly.
they've put the floor in real estate.
Yeah. So exactly that same 250 condo we bought in '05. Sometimes I creep on my old properties by looking up BC assessment. That same property is 1,000. I'm like, holy
Jesus.
mother,
That's
right?
I
So
mean, I bought 2010. I bought a townhouse brand new, 205,000, 3 bedroom, 2.5 bath, 1,400 square feet. Again, I'm on Vancouver Island.
mhm.
But even my family were like, "This is Alex. You're spending so much money." They were able to buy houses for 80,000. And I mean, I did sell that. in 2020 for 400. I was like, oh, you know what? It's increased. I'm pretty happy. I don't like to go back and look at that sale price again anymore
Yeah.
because it went up a lot more from 2020.
Have you looked at BC assessment? What's worth today?
650 is
Okay,
what
so
if it's still today.
it went up
Yeah.
threefold. Now,
Yeah.
normally, well, I won't say anything's normal these days, but historically in the Greater Vancouver area, maybe parts of like a lot of parts of BC as well, real estate has doubled in value every 10 years. I think
And
that
that's where mine
yeah,
doubled in 10 years. Like
yeah.
that was a fair, like to me, the price increase I saw on mine for when I bought it seemed like a fair. And I think that's how like it should have kept going from 2020 to 2024, like going up 250,000. That number doesn't make sense.
Yeah, it wasn't sustainable. I remember during the heights of COVID, properties went up 30-40% since 2019 pre-COVID. And
Yeah.
I mean, it's
Yeah.
come down the top. It probably dropped about 10 or 15% in the last couple of years with the high interest rates. But this news from the government is pretty much saying like housing, we can't really afford housing to go down anymore. It's like you can
Yeah.
qualify for more, but you're now taking on more debt.
Yeah, that's exactly what it is. And I mean, you have people that are going to be cheering that own homes already that, hey, sweet, my home is not going to be going down. You know, some people are like, hey, I get to get in the housing market now. But of course, there's going to be the people that are left behind that've still just been waiting since, let's say, 2010, that home prices are going to keep crashing.
Mm-hmm.
And we know the same question of like, you got to get in when you're ready. No one's going to be able to tell you if you buy today, you're going to get super rich. You buy today, it could crash. You have to be comfortable with your cost. And that's what I always look at when I buy myself.
Mm-hmm. Especially when you're buying to live in, you don't treat it like a stock where you're going to sell it tomorrow and make a
Yeah,
profit. You buy to live in, to set roots there. Uh, if you're having kids, for the schools that's around the area, how close it is it to work? How close is it to family? All the amenities or groceries, whatever close by, and you just live life. And if it goes up in value, just how it is. Now, um, these rule changes are definitely inflationary. It's like it's a stimulus to the housing market.
yeah,
So all the talk about, oh, during the last couple of years with rates being higher, like, oh, I can't wait for prices to come down. Well, it has come down already. Have you bought?
yeah,
Probably not, because the borrowing cost was so high. Well,
yeah,
this change essentially is a signal from the government saying that we don't want it to go down anymore. We're just going to call this the bottom. And this will eventually stimulate home buying and home prices.
exactly. And that's where it's just, yeah, waiting to see what happens there. I think some people are still going to be on the fence. I'm going to jump a little bit ahead here because we got massive news of the Fed cutting interest rates by 0.5%.
Mm.
Um, Now, me and you were talking about it off the screen as it was a big cut in a sense, but also like Canada, we've already cut before them. This is their first cut, and so does it mean that they're going to keep doing that, or was it just like maybe they started too late? That's like that's kind of the point to me. It's like, does this mean Canada's going to do a 0.5%? I don't know. We might already have. I think every place was too slow on it, but maybe we stick at 0.25. Maybe we do a big one. What's your thoughts?
Yeah, I feel that yes, it seemed like a dramatic move by the states, but it's essentially two 25 basis point cuts, and we've already started three times before them. So
Yeah,
it seems like maybe just the US started a little bit later than us. And this is just to pay back the moves that we've already made. I think this does open the door for Bank of Canada to do the same. I'm hoping for it. I'm sure all the variable homeowners who have HELOCs or whatever are hoping for it as well. It
yeah.
remains to be seen.
I mean, the change like every time this news like comes out, and this week has just been crazy for that. Is like the Bank of Canada's rate was saying, hey, maybe it's going to come down to 3.5. We're at 4.25 right, 4.45 right now. There's talks that this could go down to like 2.5,
Yeah.
which I mean, we could see interest rates on a variable at 3.5% again at that, which
Yeah.
is, I'll tell you this. I didn't think we'd see that again. I thought we'd be around 4% for the next little while.
Yeah. The key lending rate, the forecast was between 2.5 to 3%. But if we are going to follow in line with the Fed and also do a 50 basis point cut in October, like how we projected it last pod or a few pods ago, where we're expecting around 1.75%. It could be more. It could be 2% or a little bit more. It just remains to be seen, just especially with Powell saying that the time has now come to lower interest rates after a 23-year high, and that they've gained greater confidence that inflation is moving substantially or sustainably toward 2%. Now, couple,
Which
yeah,
is, uh, I'll say, like, we know that a lot of our inflation for the last 6, 7 months, our numbers have been saying we're higher. But again, we in Canada, we keep like shelter and interest rate costs into it for mortgages. And so we've already been at 2% for a while. It's nice to know that we have hit their target rate here in August. But now the fear for the central banks is, well, are we going to hit deflation? Have we cut too much, kept it up too high, and now that's why they're going to have to cut fast.
yeah,
And
it seems like the last couple of years, the government, with COVID, in response to the pandemic, you know, cut rates to near zero, had SEBA, CERB, all the free money that was flowing the market to keep people alive, keep economies going, fine. And it wasn't just Canada; all the countries around the world did the same. So we're stuck at home, couldn't travel, had a ton of savings. So what did people blow their money on? Amazon, home fitness, and wanting to get out. And there's a mass decentralization of downtowns where we were stuck in prison, like house arrest in the sky, and couldn't go to the restaurants, go anywhere. And divorce rates went up because you're stuck at home with your spouse, and whatever rocky relationship you have, it get accentuated by being around each other for so long. And what happened was a lot of people went out to the outskirts, to the suburbs, to get more space, more land, to get more separation from people. Well, now that and inflation went crazy, 8-9%, and the government said, "Oh, inflation's only transitory." Well, it's not transitory. And when they finally realized that and tackled the inflation by jacking up interest rates, by then it was already too late. So it was almost like a pendulum that was
that's
just swinging each way. So
God, that's
they had to make a huge cut for the pandemic, and then now we had to
yeah.
increase borrowing costs to offset the whole gluttony that's been happening. Now, too much of a cut. Now we got to bring that back down. So eventually, I think we're going to settle in the 3.5-4% range on the interest rate wise, how it was pre-COVID. They call it the neutral range, where it neither causes inflation or causes deflation or disinflation, is what they say.
Yeah. Yeah, and that's where like the first time COVID, we all got caught with our pants down. We didn't know what that was going to do. Inflation, the government reacted way too slow. Maybe I expected too much of them, but we talked about it like we're doing all these rate increases, but we haven't even given them a chance to filter through. They could have put other measures in place to slow down housing. Like they could have put other stops instead of just jacking up rates. But the trickle effect of these high rates is going to be scary the next few years.
Yeah.
Because it means we're going into a bad economy.
Yeah.
Which are people going to lose jobs? Hey, people on variable rates is going to be nice for them. But I think you'd rather have a higher interest rate than no job.
Mm-hmm.
And that's where have to think of what's going to happen that way. And I hope they have the slow, like the soft landing. I don't know if that's going to happen.
Yeah, I know a lot of people who are clamming for lower interest rates. That is great. But I think more people are worried whether they're just still going to have a job at the end of this. Companies now are laying off. You're hearing more and more stuff about it. And as much as we think the market is going to take off with these new changes, it may not right away, because people are worried about their job security. So when that happens, less activity, maybe the market will just return to a more balanced condition.
Yeah. And like you said, there's people that moved out to the suburbs and everything, and they're getting called back in now. And like, where do they get? Like, they're gonna have like we do have a lot of stuff like condos. Like the market is crazy. There's so many condos on the market right now, which we've seen prices dropping, and there's actually excess supply. And if people have to move from the suburbs to get back to actually make it to work, what's going to happen there? And so it's definitely an interesting time.
Yeah, absolutely. Well, now there's one more news that we wanted to share before we get out of here is our inflation numbers for August came in at 2%. Technically, it's 1.95%, but they rounded up to 2%.
Yep.
But that kind of
Yep.
adds to the narrative that the talk is not really inflation anymore. Now it's almost like recession, right? Yeah.
Exactly. And
So,
that's I want to explain something because I've noticed I posted a couple things on inflation. I want to make sure people understand what inflation is. It does not mean prices are going to stop. The easiest way to look at it is, let's say before a steak used to cost $10 to buy. Because of the high inflation we've had, it now costs $20. It does not mean that steaks are only going to go back down to $10. It means they're going to be at 20, but they're only going to increase at ideally 2% a year.
yeah.
Um, a lot of people get that very confused and they think, well, the government caused it. It's like, well, the government didn't really. It's actually the companies. Like they've been saying, oh, I need more money from you because it's costing me. And I really would love to see their profit sheets. I
Mm-hmm.
do not believe their profit sheets have dropped at all. And they've just been making excess profits.
Yeah. Yeah. So only time prices go down is when there's deflation. And when there's deflation, like if inflation's negative, then we are in a world of hurt as an economy. Like we're talking like mass layoffs, delinquencies that spike and all that stuff. And we
Yep.
don't want to get into deflation category. So unfortunately, these high prices are kind of here to stay.
Yeah. But hopefully, I do hope that we can start to see people get some more wage growth. Like, if you look at wages, like I know people that were from 15 years ago were making the same hourly rate and it's not good now. Back in the day, it was amazing. I mean, we go back, people could buy homes with like people being bus drivers and working at like tellers.
Mm-hmm.
We know that does not work now, but I do hope that people are doing trades, start to get paid more. Like I know carpenters that are working out in the rain, getting paid 25 bucks an hour. Like those numbers just don't make sense to me.
Mm-hmm. Back in our day, like my parents, when they qualify to buy a home based on buying a home is maybe two or three times their income. Now,
Yeah.
over the course of decades, that number has ballooned to like 9 or 10 times or even more,
Yeah.
especially in like Vancouver area and the greater Toronto. But yeah, we just hope that, yes, the economy is going into the toilet. Good news for rates, not so good for the economy. And we hope that you viewers, listeners out there, that your job is not affected because there is going to be
Yeah.
some layoffs because of this. So
I'll put one other thing because I actually just got an email about it. Is like with rates coming down, and we talked about this before. People need to look at their penalties with mortgages. As rates come down more on the fixed side, the banks make profit on people breaking their mortgages, and you just deciding, hey, I'm going to break my 6% to try and get a 3.5%. You could be looking at a $50,000 or $60,000 penalty. It needs to be discussed before this happens.
yeah, so there are opportunities out there. We mentioned it in the previous pod, but there are opportunities out there if you're in a 6% uh, mortgage to break out to get a lower rate mortgage. There are opportunities out there, but if you choose to wait and for more decreases, like what Alex has said, banks will increase their posted rate to make the penalty even more to offset whatever savings that you think you would get from a bigger discount. So keep that in mind. Talk to a mortgage professional to run the numbers for you. See if the numbers make sense to make the move. It may not always, but if it does, it's worth looking into.
Yeah, exactly. Well, I think we dove into a lot here, Alex. I don't think we need to give anyone else information. I've never had to make so many videos and updates for people because of all this information in one week. So I think we're ready to sign off
All
here.
right, great. Thanks so much. For my co host, Alex Shanks, I'm Alex Pang. Thank you for catching this emergency pod of the Canadian Mortgage Show. We'll see you next time.
Talk to you later. Now, if you enjoyed this episode, make sure to like and subscribe. If you're listening on Spotify or Apple, make sure to follow us. Please give us a 5-star rating. You can even send us an email because we want to know what you guys want to hear about. That's what we're here for. Reach out anytime.